Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Okay, happy Monday everybody. As always, I trust you had a restful weekend and have a productive week ahead. It's Monday, so we have an economic heavy episode today. Before we cover the concerning developments, let's start with some positive news. Or at least positive for the folks with Jack Ma's Ant Group. Last Friday, the People's Bank of China announced that financial regulators had fined Ant Group Co. Limited 7.1 billion yuan, $984 million US. Why is this good news? Well, it suggests that the years-long government-led restructuring of the fintech giant may finally be coming to an end. This means, among other things, that the company may finally be able to revive its IPO plans. Officially, the company was fined for violating regulations related to, quote, corporate governance, financial consumer protection, payment and settlement, anti-money laundering, and sales of investment funds, end quote, according to the People's Bank of China. We remember that Ant, China's biggest online payment platform, first got in hot water back in November 2020 after billionaire founder Jack Ma publicly criticized financial regulators at an event in Shanghai. This was the immediate trigger. However, it was also part of a wider regulatory crackdown on internet companies in recent years by a Beijing concerned that the giants had become too unwieldy and were engaging in monopolistic practices and antitrust behavior, and in April 2021 embarked on sweeping business restructurings, which included turning itself into a financial holding company that would be subject to the rules and capital requirements similar to those of banks. Ant Group has also had to distance itself greatly from e-commerce giant Alibaba, also part of Jack Ma's progeny. In January, Ant Group announced that Ma would give up his controlling rights over the company. Chinese financial media outlet Caixin writes over the weekend that while Ma's relinquishing of control could clear the way for Ant Group to revive its IPO in China, it will not happen within the year due to listing regulations. The Shanghai and Shenzhen stock exchanges' main boards require companies that have undergone a change of their actual controller to wait 3 years before going public. The Hong Kong Stock Exchange requires a 1-year wait, the outlet writes. In an article published earlier this year, the same outlet reported, citing China Cinda Asset Management valuations, that Ant Group is likely worth between 58 and 72 billion US. Indeed, on Saturday, Ant Group announced a share repurchase plan that values the company at approximately 78 billion US, likely to let some investors exit and to replenish its staff incentive pool. This, of course, is a massive drop from the $300 billion plus US value ascribed to the company in mid-2022 before its aborted IPO that year. At this new price point, Ant has thus seen a 75% collapse in value versus its initial pre-IPO levels. Next up for the economy. China Index Academy has published its latest data on Chinese land sales, and unsurprisingly, the numbers remain poor. Let's begin with the positive. According to a report of 50 cities, demand remained strong in first-tier cities like Beijing, Shanghai, and Guangzhou. Provincial capitals, Chengdu, Xi'an, and Hangzhou also did okay. However, the promising news ends there. All the other cities surveyed fell under their land sale targets to varying degrees. We remember, of course, that land use sales are a critical source of extra budgetary income for currently cash-strapped local governments. But with the ongoing housing crisis, demand from private developers has fallen through the floor. As we saw last week, the situation has become so desperate that some local governments have directed local government financing vehicles to buy up land in order to replace the private sector shortfall. Chinese financial media outlet Yicai Global, citing a China Real Estate Information Corp Research Center report, wrote over the weekend that, quote, the land market was generally cold nationwide in the first 6 months of the year. Developers are eager to buy land in core first-tier cities, while some auctions in third- and fourth-tier cities attracted no buyers at all. End quote. Next up, China's central bank buys more gold, and international investors sell their Chinese stocks. Hey everyone, if you enjoyed today's episode of China Update, don't forget to hit that like button. If you're getting some value from today's episode and you have not subscribed, like 50% of the viewers, maybe consider subscribing. And it's also a massive help if you can share this episode with someone who you think would enjoy this sort of content too. This is the best way to help the channel grow. And for anyone who can go the extra mile and help keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. Thank you so much everybody for all the support. Okay, let's continue with our economic updates. According to official People's Bank of China data published over the weekend, China added 23 tons of gold bullion to its reserves last month, representing its 8th consecutive month of increase. In yet another sign that the central bank is concerned about the geopolitical situation and wishes to distance itself from the US. Total stockpiles now sit at 2,330 tons. Of course, China's actions are also part of a wider global trend. As inflation has accelerated and monetary policy tightened around the world, central banks globally have been buying up the precious metal. According to a World Gold Council May report, 24% of monetary authorities intend to increase gold holdings over the next 12 months. And finally, geopolitical uncertainty is not just driving Beijing to buy more gold, it's also pushing international investors to reduce their risk by diversifying away from Chinese equities. Over the weekend, US financial media outlet Bloomberg published a report looking at the rise in emerging market portfolios excluding China stocks. Nearly non-existent before 2015, the outlet writes, such products sprang up last year as the investability of Chinese equities came into question, with 12 launches, including from Goldman Sachs Asset Management. Another 5 came to the market in the first half of 2023. Including BlackRock Inc.'s fund. The outlet explains that the trend underscores a growing belief that the country is too big and complicated to be lumped with others. Quote, one has to ask, what are the potential consequences should China get involved in a conflict with other parts of the world? In that event, what would happen to your investments related to China? That's a legitimate question and supports a long secular trend of thinking China as a segregated allocation. End quote. In a similar statement, a portfolio specialist at William Blair International also expressed, quote, geopolitical risks, regulatory risks, and broad concerns regarding the investability of China has been bigger drivers of increased interest, end quote. And so far it seems this new strategy has been a good bet for investors. The MSCI China gauge has fallen 8% this year, on track for a third straight year of losses, while a developing market index excluding Chinese firms has seen 11% growth. Of course, it would be wrong to say that all investors are running away from China. Big players like Alibaba, Tencent, BYD and others still enjoy a lot of foreign support. And indeed, some investors will likely see the relatively cheap mainland firms listed on Hong Kong's Hang Seng Index as potentially very attractive opportunities. In saying this, however, it does seem like international capital is very much pricing in a good helping of risk and uncertainty when looking at China stocks. Quote, we are now seeing clients actively asking for such mandates or putting in investment guidelines restricting exposure to Chinese assets. This underscores a clear trend that investors are seeking China-free investment options within the broader emerging market space. End quote. Okay, that is today's Monday episode of China Update. Thank you so much everybody for watching. Have a great day, have a productive week, and I will see you all tomorrow.